more things within this company have changed that makes it a higher risk, which means that people want a higher rate of return on their bonds, which in case something goes wrong. Some factors can do that. So hopefully everyone agrees that if at $5,000 I get an 8% return, if I get it for less, my return is going to be higher, percentage-wise. Because I'm still getting $400, but if I only have to pay $4,900 for it, then I'm getting 8%. I'm getting more than 8%. So I'm getting $400 a year on a $4,900 investment. So the less that I pay for it, the more my rate of return is, which is the way the market demands a higher rate of return on investments. So they'll just discount it. So this thing is out on the market now, and they can't sell it for $49 or $48 or $4,700. No one wants to buy it. But when they price it at $4,500, it clears. They get rid of it. Which then means that the market price for this bond is $4,500. And the rate of return is higher. Well, now I've got all of the cash flows known, and this is a different type of problem than we've looked at up until now. All the cash flows are known, but I'm asking the question, well, what's the interest rate? Okay, well, I know what the present value is. I mean, that's what people are willing to pay for it. What is the rate of return on that investment if those are the cash flows that arise? Well, it's sort of a messy sort of equation to solve, because P given A is not a really easy formula. And so what we can do is use an approximation technique, which I like to call sort of linear interpolation, basically. So making some guesses and then interpolating. So I want to approximate the answer to this question, what is the rate of return on this investment, by trying to solve that equation using trial and error and linear interpolation. And what I really want to do is observe that if I have a look at the present value, the present value of that future payment stream as a function of I. Well, for example, we know at 8%, it's worth $5,000. Okay. Well, if I just take that without having $4,500 written up, if I plug 8% in there, I'm going to get $5,000. And we also know that as the interest rates go up, the present value of that stream, in other words, it's worth less. So at 9%, at 10%, at 11%, the present value of that payment stream is worth less. So the issue then is, well, what is an appropriate number for that? Well, we can solve it exactly using something like Excel. Or what we can say is, let's do some trial and error. First of all, 8% is the wrong answer because it's too low. Right? Because it's selling at a discount, investors are going to get a higher rate of return. So why don't I guess 9%? And let me plug 9% into this equation. Okay, well, if I do so, I'm going to get 4679. In other words, if someone pays $46.79 for it, they're going to get a 9% return. But they're getting it for $4,500, which means the return is higher. So my next guess is going to be 10%. I'm just going to use the tables that are in the back of the textbook so I can do the calculations easy. So there's an 8% table, there's a 9% table, there's a 10% table. So I put 10% in, I see 43.85. So my interest rate must be somewhere in between 9 and 10%. Right? Because at 9%, at 46.79, I'm earning 9%. At 43.85, I'm earning 10%. Well, I'm paying 45, so I'm somewhere in between. So one way of approximating that is to do that. Let's have a look at these 2 points. Present value, 9%. Present value, 10%. Okay. And what we're after, of course, is this value here, where the present value is 4,500, and that's the I we're after. That's the solution to this equation. Let's take the assumption, and of course it's just an assumption which is not bad, that within a very small region, that equation is linear. So within the region between 9% and 10%, it's more or less linear. Of course it isn't, but it's close enough approximation. If I do that, why don't I find out what the slope of this line is here, between these 2 points, and then since it's linear, just say, well, the slope between this point and this point, or this point and that point, is the same, which will allow me to solve for I. So essentially what I'm doing is I'm saying, what's the slope of the line? Well, PV 9% minus PV 10% over 9 minus 10. Slope of the line. I've chosen these points because they're easy to calculate. There's a 9% table which will give you those factors without any work. There's a 10% table that will give you those factors without any work. So you can come up with those numbers really easy. And then say, well, if that's the slope between here, the slope between here and here is the same, because I'm assuming it's linear. So why don't I just equal that to present value I, so the slope between here and here, and that's what I'm doing here. Minus present value 10% over I minus 10. Just solve for I. Okay. So the key thing is the function of linearity. Well, if I do that, I get something like 9.6%. So what I'm saying is that if an investor pays $4,500 for this bond, he or she's going to get a 9.6% rate of return. Plug 9.6 into that equation, and you get $4,500. So the steps in the process are, well, one, identifying, is it selling at a discount or is it selling at a premium? If it's selling at a discount, the rate of return is higher, right? Because I'm paying less for the bond than face value. Therefore, my first guess is going to be greater than the bond rate. In this case, my first guess was 9%. I do the calculation, and I chose 9% because the interest rate factors are in the back of the textbook. And if I'm still short of 4,500, it means the rate of return is higher than 9%. Next guess 10%, I've overshot, which means it's somewhere between 9 and 10. And then simply make this linear assumption in here and solve. And you come up with 9.6%. So the rate of return on this investment to the investor is 9.6%. And those just calculations. Now the key thing here is what's assumed is, and we'll talk about this in a sec, that this equation works and the investor will achieve 9.6% rate of return only if they have the ability to reinvest $400 interest payments at 9.6%. Okay. And we'll see what happens if that assumption breaks down. So this is what we call the bond yield. So if you're asked for a bond yield, this is the calculation. Implicit in the bond yield calculation is reinvestment available at the bond yield itself. Because remember, when that 400 comes in, you're doing a future value also. Okay. So that's the bond yield calculation. And that, of course, is the case of D in the cost of capital equation. So if the company goes out to the market and can only sell these bonds for $4,500, we can calculate then what case of D is. That's their cost of debt. We talked a little bit about how to calculate the cost of equity. So that's the market-based determination of the cost of capital, which is going to be in Chapter 4, our minimum attractive rate of return. So that's the way we do it. Now, what I'd like to do is just talk a little bit about how the market prices these securities. Give you a sense of, again, everything's forward-looking, and there's this notion of opportunity cost. These are what we call bearer bonds. In other words, they're negotiable. If I have a bond in my hand, I can sell it. And let's just say this investor bought the bond for $4,500 way back here. They held it for 6 years. And now they want to get rid of it. Well, they'll sell it on the open market, and they'll get a price for it. What price will they get? Well, the price that they'll get is what someone else is willing to pay for them to buy it. Well, what were they willing to pay? Well, think about now an investor who buys, and a bond is just a piece of paper, right? A piece of paper at the beginning of year 7 entitles the new owner to 4 interest payments and $5,000 coming back. So if I'm buying the bond after 6 years, that's my entitlement. What's that worth to me? Well, isn't that worth present value at what I can do with the money elsewhere? Again, this opportunity cost. So I'm looking forward in terms of my opportunity cost investment over the next 4 years, and I'm going to value the security on that basis. That's what I'm willing to pay for. And that's what someone will be able to sell it for. And that's the calculation that's up there. Okay, so let's just say the market rate now is 12%. In other words, if I want to buy a 4-year bond of a company similar to this, I'm going to get 12% elsewhere. Therefore, I shouldn't want to pay any more than what this will give me at 12%. Right? Remember, it's only paying 8% interest, so it's going to have to sell at a discount. How much? Well, take the present value. I've got 4 payments of interest, and I got the 5,000 base value coming back, discounted at 5%, at 12%. So the market price for this bond is going to be $43.92. In other words, if someone gets this for $43.92, they will get 12% compounded rate of return, interest rate compounded annually. That's the return. That's the market determination. Now, I want to show you what that really means. And I'm going to use this in my summary example. Well, let me ask the question. What does it mean if someone tells you, I got this bond for $43.92, and I'm going to get a 12% rate of return? What does that mean? Well, ask the question, at the end of the bond, how wealthy is this person going to be? That's one way of looking at it. So I'm going to argue that if the claim, I may need 12%. Well, I would hope, and hope everyone will agree, that if I pay $43.92 and 53 cents for this bond, let's ask the question, future value, end of year 4. Okay, where I'm now looking at it from the new investor's point of view. So this is year 1, 2, 3, 4. Right? And from the new investor's point of view, that's 0. Well, what about that? If the person ends up 4 years from now with 12% compounded 4 times, isn't that what it means to receive 12% rate of return on investment? Everyone comfortable with that? So if at the end of all of this, the person has this amount of money, $69.12, that person can claim, I made 12% a year. Now, let's ask the question, well, where does that value come from? Okay. Value comes from the investment. Okay. Well, there's 4 interest payments, and there's $5,000 face value repayment. So, the future value of the investment comes from what? Well, it comes from $5,000. And I'm saying, at this point here, end of year 4, where does the value, how is the value created for this new investor? And he's got 4 payments. Excuse me, 1, 2, 3, 0. F given A, 12% common 4. Just the future values. Okay. If you add this up, it's 69.12. Because you can get this number out of the back of the textbook, 77. So the value of the investment comes from the 4 interest payments and the $5,000. And that equation suggests that there is $69.12 worth of value from the returns on this investment, which is what he needs to be able to claim that he made 12% per year. That's the limit. Now, where does it break down? What's wrong with this equation, if anything? What do you think?
Interest rates.
Interest rates change. For this to work, he has to be able to take that $400 and put it somewhere and grow it at 12%. Normally, you get more interest on a $5,000 bond than you will on a $400 investment in the bank. So this approach, if he can't attain 12% per year on the interest payment, overstates the value. And this is one of the interest rates we talked about initially. This is what we call the reinvestment rate. When I mentioned the bond yield, if you recall, I said for that person to receive 9.6%, i.e. the number that comes out of this solution assumes that the person can reinvest at the bond yield, 9.6. That's exactly what I'm showing you here. For this person to achieve the 12% rate of return, implicit is that they can reinvest at 12%. That's just the definition. Yes, sir, of the bond yield. Yeah.
So it said that 6912 would be is the future value of the annuity once it's sold at year 7. So is that the new person that's going to make that much money?
Okay, the new person, okay, the old person hands off the bond and receives $43.92.
Right.
Okay, the new person has $43.92 invested in the bond and will receive over the next 4 years 4 interest payments and $5,000. So think about the new person standing here, looking forward. End of year 1, end of year 2, end of year 3, end of year 4. Okay. To the new investor, because the old investor's done, right? They just got the money and they could ask, well, how much did I make over the 6 years? Oh, that's not interested, that's just history. But going forward, this person says, oh, over these 4 years, I want 12% a year. So my argument for him to claim that is he needs $69.12 here. So if he has $6,912 at the end of this, he can claim that he made 12% on this $43.92. That's the first point. Is that okay?
I'm getting confused in the definition up there.
Okay.
That's saying that we need that's the annuity plus the final value at the present worth.
Okay. The two are synonymous, remember, because of equivalence. The first thing, 3 steps here. The first step is, what should that person pay, okay, for this bond to get 12%? Okay, and that's just a calculation. So I'm telling you that if you take the present value of that, that number is what gives the person a 12% rate of return. So, okay, so that's step 1. Maybe I'm not clear enough here. So step 1 is, what equivalent sum of money here is equivalent to that at 12%? So step 1 is $43.92. Okay. Steps 2 and 3, or step 2 is I want to prove to you that indeed this person is getting a 12% rate of return. Okay. So step 2 is just a definition. If he pays this for the bond, then shouldn't he have $69.12 4 years from now if he's making 12%? So think about putting $43.92 in a bank account, paying 12% a year. That's what you're going to get. Okay? Okay. That's step 2. Now step 3 is, where does that value come from? Well, that value comes from, remember, he doesn't have the money anymore. He gave it to the old bondholders. It comes from these 4 cash flows plus the repayment of principal. And what I'm showing you is the only way to get $69.12 out of this investment over 4 years is to be able to reinvest the interest at 12%. Okay. That's called the reinvestment rate, and if it's not achievable, then indeed he's not going to get a 12% rate of return. The way to flip it around, going back to point 1, is when I do this calculation and determine this number, implicit in that is that these cash flows can be reinvested at 12%. That's what the present value formula assumes. So I'm trying to get at that. Okay. So it's really 3 separate steps. Okay. And this is really key to understanding valuations in chapter 3. Okay. Now, in my review session, or our review question, we'll touch on this again. Does that give that? Think about it and ask you the review question. Maybe that will be good. Okay. So if this is not true, so in other words, $400 comes in here, and you can only put it away at 8%, well then you're not going to generate $69.12, and so your real rate of return is not going to be 12%. Okay. But implicit in all of this again is that you can indeed do that. Okay. So bonds sell on the market depending on what the interest rates are for the remaining period of the bond for comparable companies, comparable investments, and they go up and down. And indeed, if interest rates change, you can actually pay a premium for a bond. If interest rates have gone down significantly. Okay. Let's 2 very, very quick topics. When we talked about, I guess, depreciation and setting prices or setting rates, we talked about identifying all of the costs, and one of those costs was the cost of the machine itself. So if I've got a piece of equipment and it's going to last in my project, in this case here, for 4 years, when I set my rate, I want to have some sort of allowance in that rate or that price to cover the cost of that machine. And initially, we just used straight line depreciation as one way of doing that. But think about the two components of cost in terms of having a machine available for my project. One is the loss of value, the depreciation. But think about that, because I'm always borrowing money, I'm always using investors' money, that I've got money tied up in that machine, and I need to pay interest on it. And so this capital recovery factor allows us to capture both. In other words, what's the loss of value of this machine over the life of it for my project, and how much am I paying in interest in money I've got tied up in the machine? That's the two things this thing captures. And the equation is quite simple, because it looks at essentially taking the initial cost and spreading it out as an annuity, and then looks at F was really the salvage value. So what do I expect to get for it? Well, that's a credit, right? Because that reduces the cost of my machine, and take it as a credit over those corresponding same end years. Okay. And example is probably the easiest way to explain this. If I have a machine that's worth $60,000, and I've got a 4-year economic life, so my project life is going to be 4 years as well, and the engineer right now estimates that after 4 years we can sell it for $20,000. Okay. So a little bit of arithmetic gives me a capital recovery of $14,620. So when I'm setting the rate for the service, I'm going to look at the labor, I'm going to look at materials, and I'm going to include $14,620 as one of the costs to help me set how much should I charge for this project. Well, why does $14,620 represent the right number? Well, I want to show you that indeed I'm going to cover interest on the money I've got tied up in the machine each year, as well as cover the cost of the machine. This is just like one of the bank mortgage type questions that I looked at earlier. So think about if I go to the market and I raise $60,000 and it costs me 10%. Well, the first year I've got $60,000 tied up in that machine. It's working in the project for the first year, and I have basically a 10% interest charge. So I've got a $6,000 interest charge on the money I've got tied up in that machine for the entire first year. At the end of the first year, what happens? Well, I've set my rates high enough so that I get $14,620 coming in to cover the cost of this machine. What am I going to do? Well, first thing I'm going to do is pay down the interest. And then the balance of the cash, I can, in theory, pay down the loan. Okay. So in other words, I've got $86,20 of free cash, and I can pay back the loan on this machine, which means I've only got now $51,000 tied up in the machine. So for the entire second year, I've got $51,000 tied up in the machine. I run my project, and I get another $14,620. So same thing happens. Interest goes down, of course, because I owe less, and the capital recovered becomes more. So what happens? Well, at the end of the project, first thing I'm going to observe is that each year I've covered the interest on the money that I've got tied up in the machine for that year. And secondly, I've covered the full $60,000 in the machine because I've set the rate high enough that I've recovered $40,000. Plus, at the end of 4 years, I'm going to sell the machine for salvage value of $20. So I've got my customers to pay for my machine because the rate's set high enough, and for the interest on the money that I've got tied up. Okay. So it allows us, it's a little more comprehensive than the depreciation charge in the sense that it takes time value money into account as well. Okay. So again, for a rate setting exercise, if you want to know what capital recovery has to be, this is the way to do it. Okay. So 40 plus 20, 60, cost of the machine, as well as the interest on one title. Pretty straightforward. Okay, final topic is, and this is just for completeness, oftentimes interests change throughout our planning period. I'm not rendering quite right. Those are supposed to be squirrely brackets, but I'm not sure why the computer doesn't like it. And, over time, interest rates change, our cost of capital changes. Engineering economic computer tools allow us to handle that really easily. I mean, if you need to do it, you never do this in a problem, so this is just for just completeness. Essentially, you need to have valuation points in between where the interest rates change. So at boundary points, you have to do the valuations. So if I'm asking the question, what's all of this worth at the end of the project? Well, I'm going to have an intermediate valuation point where interest goes to change from 5 to 6%. And of course, I'm going to forward value at the appropriate 5% there. That sum 6%, and then the next sum at 7%. So the key trick here is just to have valuation points at the boundary points between where the interest rates change. Okay. Okay, well that's basically chapter 3. And what I'd like to do is just look at an example and hopefully tie everything together, and it's a good time to ask any questions if you have any. And what, it's a bond question, and I'd just like to talk a little bit about valuation and how it works. It's important. Okay, so what I'd like to do is, first of all, define the bond. And I'd like to look at it from an investor's point of view who likes this bond but wants to cash in the bond early. Okay. And the first part of this is, well, what should the person basically have to pay for this bond, and what should the selling price have to be for this bond for her to achieve a rate of return? And then I'd like to look at the flip side of that, is if she has to sell it in somewhere throughout the course of this bond before it matures, how do we determine how much she's going to get for it? What does it look like in terms of the new investor? Okay. And let's try to do evaluation from both points of view to try to see how it works. Okay. This is an IBM bond. Okay. So this is an IBM bond. Okay, and its bond rate is 8%. And it happens to pay interest semi-annual. Okay, and this is simple interest, right? 8% divided by 2. Okay. As we mentioned, it pays interest on face value. That's the way bonds work. And I have an investor, and her expected rate of return on this investment, in other words, she doesn't want to buy this thing unless she's going to get 10.25% per year. Okay. So this is, think about it, the investor demands. Okay. And over here, I just want to keep track of the various interest rates. Keep everything straight. Okay. We have 5 interest rates that may apply in a financial analysis. First one is the bond rate. The second set is really expected rate of return. So I've got 2, 3, 4. I've got the nominal rate. I've got the per period. And I've got the effect. And then finally, I've got the reinvestment rate. Okay. And this summarizes everything in chapter 3. Okay. So this is all I can throw at you. Okay. Now, can we populate any of this right now? Well, the bond rate defined by the project, or sorry, by the financial security is 8%. Okay. Now, what about 10.25%? She's demanding 10.25% on her investment. Where am I going to fill that in over here?
Effective.
2 or 4? 4?
4.
That's right, because that's actually what she wants. Right? We don't care about compounding or anything. She says, I want an effective rate of 10.25% or I'm not going to buy this thing. So 10.25. Okay. And the rest of it will come later. Okay. Well, let's have a look at the security itself. Well, I've got this bond. And sometimes it's useful to do a timeline, which I'll do here. And the other thing is, market price is $49,000. $49,000. And face value is a $50,000 bond. Okay. So it's selling at a discount. It's getting market. Okay. Well, let's have a look now in terms of time. 1, 2, 3, 4. turns of years. So first of all, you can buy this for $49,000. The first thing we can populate it with is you're going to get return face value no matter what you buy it for, right? So face value means you're going to get 50 grand back. Okay, 5 years from now, it's a 5-year bond. That's what I said that. 5-year bond. Okay. And what about the interest? Well, interest, remember, is paid on face value. We don't care what we paid for it. So $50,000, 8% a year, but it's payable twice, right? It's payable semi-annually. So that is, what is that, $2,000. Okay. So if it's payable semi-annually, this is what it looks like to an investor who buys it and holds it to maturity. Please.
Are those numbers part of the question? 49,000.
49,000, yes. You're being told that you can buy this for 49,000. Okay. If you hold it to maturity, can I tell for sure what the rate of return is? If I hold this thing for 5 years, can I tell for sure what I'm going to do in terms of return? There's no risk, there's no uncertainty here, right? I can figure out the bond yield, and that'll tell me what my rate of return is. Okay. But she doesn't want to hold it. So is everyone comfortable with that? If I hold it to maturity, there is no risk in terms of my rate of return, because I'm guaranteed by IBM for these payments, and I'm guaranteed to get my money back. So I know the bond yield is my rate of return, and I'm done. But she wants a 4-year investment, and IBM doesn't have 4-year bonds. In other words, she has a need for her money. She wants a 4-year investment, 4 years from now, but she likes to buy the IBM bond for whatever reason. So let's look at it from her point of view. Well, IBM is not going to give her money a year early. That's not part of the term. So I'm going to say let S4 equal selling price at end of year 4. Right? So look at it from her point of view. If she's going to unload this thing at the end of year 4, then what's going to happen? Well, she is going to sell it in the open market for S4. And what does the bond look like to her? The bond looks like now, can she tell what her rate of return is? No, because this is an unknown. Whatever she can sell for it, whatever she can sell it for 4 years from now is what she's going to sell it for. So if you hold a bond to maturity, you know exactly what your bond yield is going to be. If you plan on selling before, it is uncertain because the market conditions dictate what S4 will be out of her control. So the way the trend is complete.
So the maximum value of S4 would maybe the present value of the remaining payment?
S4, yes. Because what would someone pay for this bond?
They wouldn't pay more than...
They wouldn't pay at some interest rate. Key thing is, what's the interest rate? So let me flip it around, because that's the second part of it. Let me ask the question, for her to get her demanded 10.25% rate of return, what does she have to sell the bond for? Can I do it that way? And then we'll ask the question, which is the question you're addressing, what will someone pay for it? What is the present value of what's going over? Okay. So the first part of this is to say, well, what does she have to sell the bond for her to achieve that rate of return? Okay. Well, I'm going to start by asking the question, at the end of 4 years, how wealthy does she have to be able to claim that she made 10.25%? Okay. Well, I'm going to argue, like I did with that previous example, that if this investment generates FV4 worth of value, then it will return, well, 10.25%. Where, let me define FB4 to be that if she spends $49,000 on this thing, and she keeps it for 4 years, well, if you put $49,000 in a 10.25% bank account, I hope you'll agree, this is how much money she's going to have. So for her to claim that she made 10.25% on 49 grand, that's how much she has to have at the end of 4 years. This is key to understanding this example. Is that okay with everyone? That's simply the definition of making 10.25% a year compounded for 4 years. The definition, nothing more. Okay, keep understanding. Okay, so what's that number? That number is 72 grand and 395. Well, where does the value come from? Well, she bought the bond, so she doesn't have the 49 grand anymore. It is the IBM bond for the next 4 years. Well, what is the value of that? Well, the future value from the bond is going to be, well, first of all, remember, we're valuing it right here now. This is where FD4 occurs. Right? From her point of view. Well, she's going to get S4 because she's going to sell it 4 years from now. So the first part of this is S4. But then she's going to get some interest payments. How many of them? Well, there's 8 because she's keeping it for 4 years and she's selling it at the very beginning of year 5. So the 8th interest payment goes to her. And what's that going to be? Well, that's going to be F given A, some interest rate on the I. Okay. So that's where the value of this investment comes from. Okay. Which hopefully will be 72,395 if she's going to get 10.25%. Okay. Well, I've got again a annual rate, and I've got a frequency of cash flows on annual. And so what I need to do is always line up my interest rate with the frequency of cash flows so that I can figure out what the future value is. So really what I have a problem here is in terms of 6-month periods. And so if I want to value that, let me now figure out what the 6-month interest rate is. So I'm going to define that I6 equals 6-month rate. Simply because cash flows happen every 6 months. And I have that somewhere here. Okay? Yeah, my I effective formula is something like this. Well, I've been given essentially this number. Right? So I'm giving him the effective rate. So the effective rate really is, and I want an I6 that's equal to 1 plus I6 squared minus 1. If I solve for this, I'm going to say that I6 equals 5%. Okay? So all I want to do is be able to value that thing using the annuity formula. Remember, you can use a brute force method and do it. Actually, you can't. You don't. You have an annual rate. You need a 6-month rate to do this. So I can use the annuity formula. I just want to have a 6-month rate. So going back here, then I can basically say this is 5%. Please.
So can you explain why I effective is 10.25?
That is simply her demand. It's a given. She says, I will only buy this bond if I can get 10.25%. Okay, that's just her desire. Is that okay? That's just a problem statement. Part of the problem statement. She wants 10.25% for this investment. Well, she doesn't want bonds. Okay. So I will put this back up, but let me complete this chart up here. Okay, well, I've got a per period of 5. What's my nominal?
10.
10, right? So I could specify her expected rate of return one of two ways. I could say she wants 10% compounded semi-annually, or she wants 10.25%. Two different ways of specifying. No, a bank would normally specify 10% compounded semi-annually because it's a smaller number than 10.25. But they're equivalent. There's two different ways of saying it. Okay? Okay. So, what is this number? Well, this number happens to be S4 plus 19,098. Okay. So if I go back to our target, if this is what she needs, and this is what she's going to get, that'll allow me to solve for S4.
就是说这个方子没到期就在外面去买的是。
And the selling price then is going to be 72,395 minus 19,098. In other words, S4 has to be 53,297. Yeah, please.
But isn't she buying the bond at 8%?
Yes. That's what she's getting. But she's buying it at a discount.
But you're assuming that she paid 49,000 for it.
Yes.
Oh, okay.
But she's only getting paid 8% interest. Right? She only got it at a discount for 49. So where's that extra 2.5 or 2.25 going to come from? Only from her being able to sell it at a premium. So what we're saying is S4 has to be 53,297. That's not going to be possible. Well, we'll see. Yeah, please.
So, the step-down rate only used during the very first calculation where we're going to find the amount of annuity money we're going to get?
Yes.
And then we're not going to...
And then the bond rate is totally irrelevant. Yeah, so it's just to do the 2,000, the actual cash flow. Okay. The rest of it is driven by the valuation, which is her expected rate of return. So, if she can sell it for 55,000,
是什么
is she
？normal 还
laughing?
是说是 normal？ normal
Will she do better than 10.25?
是。
Or worse? Better, right?
人家才
This
给
is
他
the
8%，他给
minimum
人
break
家
even for
可能
10.25.
卖得到
So
应
if
该
she
是
can only sell it
把那
for
个
less,
2000块钱
she can only sell it for 51,000, then she shouldn't buy the IBM bond because she's not going to get her rate of return that she's demanding. Okay, that's the key thing. Now, any questions? Okay, so we've come at it from her point of view in what she's demanding, 10.25%, which then implies that she has to sell it for a premium, 53,297, 4 years from now, for her to achieve that. And the reason for that is she's buying it just at a discount, but that discount isn't enough to give her the 10.25% that she needs. So she's got to make that value up by selling this at a great premium. Okay. I want to just touch on, if that's okay with everyone, just want to touch on this notion of reinvestment rate. Because what I have here is implicit in this is that when those interest payments come in, she's going to be able to put them away somewhere at 10.25% a year. Yeah. That may not be possible. If it's not possible, let's say just today, you get $2,000, what are you going to do with it? Well, you may put it in the bank at 2 or 3%. So this, in today's environment, may overstate the value that can be generated from this investment. And so let me define now the reinvestment rate. And let's say you can only put this for 2% compounded semi-annually. So her ability to take cash and earn on it is simply 2%. Well, then that formula is wrong. And what do you think will happen to S4? Well, if she can't get the value from the interest payments, she's got to get the value from selling it at even a greater premium. And so if I now look at this equation and I say, let's let the reinvestment rate equal 1% per six-month period, then I'm going to do a valuation that looks something like this. SP4 is going to be 72,398 minus 2,000. F given A, 1% common age. Right? More reflective of the reality of today and what you can do with money coming in. Well, not surprisingly, she's going to have to sell the bond for premium, 58,820. Makes it even more unlikely that she's going to get her 10.25%. Okay. So is that okay with everyone? Okay. Implicit in the bond yield calculation again is the fact that she can indeed reinvest at 10.25%. If that's not realistic, we'll use a more realistic reinvestment rate. The future value of the investment is going to be less. Okay. And for her to achieve the same, she has to sell it for money. Okay. So that's her point of view. For her to generate 10.25%. The question now, and I'll just leave you to think about this for next day, is that reasonable? Well, remember, for an open market transaction to occur, the seller and the buyer both have to be happy. And as far as the new investor is concerned, what is that person buying into? Well, I'm just going to use this one here, if I may. Okay. So let's just assume this number here. Well, the new investor, for her to be happy, has to pay $53,297 for this bond. Right? And what does that person get in return? Well, a $2,000 interest payment, and 50 grand back. Okay. What's the rate of return? Well, I can very quickly write down the equation. Simple to this analysis, 53,297. F given T, I common 2, I'm going to call this I6 half. That's the future value that's going to need to be generated from this investment. And it's coming from these two payments, F given A, I6 half, common 2, plus 50,000 being returned. This is a bond yield. If you solve this, two ways. One is trial and error and linear interpolation, like I showed you earlier. Or you can write this in an algebraic representation because this is simply a quadratic. This term here is simply a quadratic. This term is a quadratic. I can solve this directly for I6 equals 0.67%, i.e. the annual interest rate, so I is going to be 1 plus 0 squared minus 1, or a whopping 1.34% per year. So the new investor is looking at this investment, and if they had to pay this for this investment, would only get 1.34%. Please.
So it shouldn't be 1 plus 0.067 squared
Thank you.
out there.
Yeah. Okay. So this, she hasn't got a prayer of selling this investment 4 years from now for $53,297, because no one will buy a corporate bond that only pays 1.34%. Therefore, there's no way that she can buy this bond and earn 10.25% like she demands. Yeah.
The first one is I4 hat.
I6? These are I6.
What about the one above?
Above?
Yeah.
Yeah. So I'm going to let I should define it, I apologize for not. I6 TAC equals rate of return to new investor for 6 months. Okay. I can do a quick solution to this next page, just to start with. Okay. As an exercise, you might ask the question, what is a reasonable rate of return for her on this investment? Okay. Really good test of understanding this material. You would start by saying, what would this new investor want for this investment? Take a percentage, 10%. That would then tell you what that investor would pay. That would then tell you what she would be able to sell it for, which then would allow you to calculate her rate of return. That's an alternative way of doing it. Okay. So you might just want to have a look at trying to put numbers along that way. I'll solve this thing out, but I'm running out of time first thing next day. Thank you.
看downside proof，你根本没有我们能做的东西。
还没上课呢。